Hi, thanks so much for tuning in to this conversation on BQ Prime. It's an earnings conversation with PG Electroplast. I'm joined by the managing director of the company, Vikas Gupta. Vikas, thanks so much for taking the time. Vikas, you had strong quarter three results where you've seen revenue growth of 75% over the previous year. You've seen a significant growth in EBITDA. The margins have all expanded. You have also guided for an increase in revenue, but I want to talk about Q3 first. The expansion primarily on account of the products business, is that correct?
Yeah, so Alex, if you see the journey for our company in last 2-3 years, we have tried to pivot ourselves towards the product business, and we have invested heavily in our in building our capacities and capabilities in the product business, primarily in the air conditioners and washing machines, air coolers, and the electronic business. So yes, those investments are bearing fruits now, and the quarter three is showing those kind of numbers.
130 crore or thereabouts, 140 crore of Capex is what was planned for FY23. How much have you spent so far? And you mentioned then expansion in the capacities. What is the deployment of that Capex achieved in this financial year?
So Alex, largely I would say the capital outlay that we had of almost around 130 crores, we have already completed all those Capexes, and those expansions in our capacities for washing machines and air conditioners has already been executed. And for in the case of air conditioners, those capacities are already being utilized in the current peak season of the production for air conditioners.
When it comes to FY23, you've upped your guidance for revenue to 2,000 crore rupees, a growth of about 80% over last year from what I can see. With that figure, and considering that you've already told us that you've fully deployed capital, what is the kind of utilization of capacity that you will have in the second half, considering that you've done most of the capacity addition as of the third quarter?
So the capacity additions that we have done will give us a revenue of almost around, like when we are able to utilize all those capacities in the washing machines and the air conditioners, because there is always a lag. Please understand, there is a lag between when you do the Capex and how you are able to generate the revenue out of that. So going forward in FY24, we can see the results of that Capex that we have deployed in FY23. So we can have incremental sales of almost around 500 to 700 crores coming out of this Capex that we have done.
So then would you say that for FY24, the guidance for revenue would go up to 2,500, 2,700 crore?
So,
or is it more than that?
So that can be the scenario, but I would like to resist myself from giving a specific guidance for FY24 as of now, because we are still working out the numbers. We are already in discussions with our clients. We could be coming out with a specific guidance going forward in the month of March or April.
Okay.
But it should be nearly that number that we talked about.
Okay. You mentioned that air conditioners, you already started utilizing the additional capacity. But I was actually curious, we're already in the fourth quarter. What is the kind of utilization levels that you're currently seeing with your existing capacity across? And you said that the focus, of course, is in the products business and electronics.
So, Alex, I'll talk about specifically about the air conditioners, because right now we are going through a peak productions for AC's product. So here we are able to utilize our capacity to a level of almost around 75 to 80%. In case of the washing machine, where we have also expanded our capacity. Typically, this period is a lean period for washing machine business. Going forward, once there is an onset of monsoon from the months of May and June onwards, we should start seeing the ramping up in the utilization of capacity for washing machine as well.
Okay, now you mentioned that there has been a pivot in the business for PG Electroplast, and that is evident in the revenue share numbers that we see for the third quarter. I see that the products business is now contributing close to 60%, and the plastic moldings business contribution is falling quite significantly. Does this level hit the mark that you want to achieve, or do you see a further skew towards products and electronics staying there, where plastic moldings continues to lose share in revenue?
Please understand, Alex, we are not going to sacrifice our component business, plastic component business. So that will still remain a significant part of our revenue. And we are seeing a incremental growth in that plastic molding business as well.
Hmm.
But what is happening is the kind of ramp up that we're seeing in the product business is much larger as compared to molding business. So definitely going forward, the share of business for the product business will still go higher as compared to now.
Based on the trajectory and your expectations, I saw the investor presentation and you're quite hopeful of a strong growth in air conditioners as well as washing machines, air coolers. So based on that expectation and the capital that you've deployed and you will deploy in FY24, where do you see that share going in the new financial year and perhaps over the course of the next couple of financial years?
So if you look at our numbers, so we are expecting the product business to contribute almost around 75 to 80% of our revenue going forward.
At which point?
75 to 80% of the revenue will come from product business.
By when though?
FY24 or maximum FY25.
Okay, so the reason why I wanted to understand this is I also want to understand the kind of EBITDA margins that you are able to generate in these in the product business, electronics and plastic moldings, because what I see is this higher revenue share that you're getting in the products business is leading perhaps to an expansion in the margins. I think 7.75%, if I'm not mistaken,
Yes.
was the EBITDA margin in the third quarter.
Alex, please understand I think to improve on the EBITDA margin, there is one important factor, how much asset turns we are able to generate through the fixed capital investment that we have deployed.
Okay.
Going forward, as the product business share will improve in our revenue further, I think the asset turns will improve. So I think the EBITDA margins should improve to a level of almost 7.5 to 8%. Please understand the current level of 7.5 or 7.8% that we have hit in this year. There has been a softening of our commodity prices, and there has been a benefit of operating leverage that has come in. So going forward, we have to see how the competitive landscape will also play out, because there will be a lot new capacities for AC manufacturing will kick in FY24. So we have to be cognizant of those facts and try to figure out how the competitive landscape will play out, and we will have to adjust our strategies based on that.
Based on the guidance for higher revenue and assuming 2,500, 2,700 crore, you're going to have to deploy significant capex in the coming year and in the following year as well. What's the guidance on capex, and is most of it going to flow into the products business?
Alex, largely the majority share of the capex will definitely go into product business going forward as well. And I cannot share the specific guidance for FY24 as of now, but broadly speaking, the capex should be in the range of 100 to 150 crores going forward in FY24. We will be expanding our capacities in the current line of products also. Going forward, we might look at exploring opportunities in other product categories as well.
Now, the last point that I want to talk about, and again, this is from your investor presentation, you made a comment about working capital going up because of the higher demand for ACs, but I also see that the long-term borrowings have gone up quite substantially as well. What is the outlook on debt? And you point out that your net debt levels have gone up. Is that going to have to go up further to fuel growth, or is it going to be through cash accruals?
I think, Alex, if we look at the numbers that we have a net debt right now, primarily the increase in net debt has happened because of the requirement for the working capital, where we had to pull in a lot of inventories for our AC business because we saw sharp uptick in the AC revenue in the month of December. So there was a lot of pulling in of the inventory. Going forward, definitely, we will like to see that the cash accruals are good enough to manage the capex going forward, and we don't have to take any long-term debt.
Okay, so will it stay as it is? Are you comfortable with the debt right now, or do you want to retire some of that?
So we are evaluating various opportunities. I cannot comment on that, but definitely we will like to reduce the level of debt that we have right now. Going forward, we are evaluating certain opportunities.
Okay, on that note, thank you so much, Mr. Gupta, for taking the time. Wish you all the best. Pleasure speaking.
Thank you. Thank you, Alex. Thanks for having me here.